So, giant hedge funds and really the rich elites are all of a sudden back to buying Chinese stocks. This coming, of course, right after a massive wave of selling and even shorting the Chinese market right before. So, what exactly is going on here? Why the sudden change of heart on Chinese stocks? Well, my name is Ale, this is my world of stocks, and in today's video, we're going to be taking a closer look at all of this and I'm going to break it all down for you. So let's go ahead and jump straight into it. Now, for starters, let's just go ahead and start by taking a look at this. We have the Shanghai Composite Index here, which mostly tracks the performance of the Shanghai stock market. And since 2015, it's crashed by almost half of its entire value, while the Hong Kong Index has actually lost 52% just since 2018 alone. Both of which, by the way, are also much lower today than they were even during the 2020 pandemic. Now, I also put an overlay here to show you that while the Chinese market lost half of its value, the American S&P 500 actually nearly doubled in size. So clearly, all of these hedge funds and asset management companies were offloading Chinese securities while picking up domestic ones, which, to be fair, there was, of course, some good reason for that, as China's economic growth has been slowing way down over the years, if they haven't even been in a recession, since nobody really trusts the numbers coming out of China in the first place. But they've also had massive lockdowns throughout the country because of the pandemic, which not only hurt their own businesses and manufacturing, but also the global supply chain because of how many countries rely on it. And speaking of China's authoritarian government and their economic policies, well, those two have been very detrimental to their economy, especially in the property sector, where overconstruction funded by massive debts even resulted in the collapse of Evergrande, which used to be the country's largest real estate firm. But as if that crisis wasn't bad enough, China even decided to crack down on some of their biggest companies, especially in tech, which they claimed was to stop fraud and various monopolistic practices. But some speculate that it might also have to do with checking some of these giant corporations before they grow too large, or I should say large enough to start threatening the ruling Communist Party, which even involved putting party members onto these companies' boards. And the control doesn't even stop there. In fact, did you know that over half of all Chinese companies are state-owned? And by the way, that percentage has been rising pretty much every year. It's pretty interesting. And because of that, the US has often complained about not getting enough regulatory access and oversight into these Chinese companies that are listed on American exchanges, which they sometimes threaten to delist if they don't comply. With all of these issues in mind, it's no wonder that both the American media and our rich elites have been pushing negative press on Chinese stocks for years, while some were even selling or shorting those stocks at the same time. In fact, let's take a look at some of this coverage here. Here's CNBC, quote, "Impossible to recommend Chinese stocks." Financial Times, "Time to avoid investing in China." CNN, "How to avoid China in your portfolio." Forbes, "Worst time to buy Chinese stocks." And that goes on and on. I remember being flooded with all kinds of articles just like this pretty much all the time. And here's some about the selling and the shorting too. Financial Times, quote, "Foreign investors dump Chinese stocks at record pace." New York Times, "Investors have soured on Chinese stocks." Reuters, "Hedge funds aggressively dump Chinese stocks." Oh, and here's one about Ray Dalio and Bridgewater. We'll talk about them in just a minute. But this one says Ray Dalio's Bridgewater, the world's biggest hedge fund, liquidates a third of its Chinese stocks and completely sells out of 13 US listed Chinese companies. Pretty interesting. Now here's another Reuters. "Big investors dump Chinese shares." Nikkei Asia, "Chinese mutual funds suffer biggest net outflow in 31 months. And actually, there were several individual months with huge selling from hedge funds, with one time the market falling by hundreds of billions of dollars in a single month. And in fact, from the 2021 highs, the Chinese markets have now seen more than $6 trillion of selling. How crazy is that? In fact, it's gotten so bad that the Chinese government even announced recently that they're now investigating all these hedge funds that have been shorting their markets because they made so much in profit. Now, I'm not saying that any of this is good or bad. Personally, I don't really care about the rich elites or the Chinese government. In my view, anyone that has that much power is going to be corrupt. But just looking at the facts alone here, isn't it pretty interesting how there was all of this bearishness and all of this selling and all of this shorting, and these giant investors were making so much money off of that, that even it got to the point that China had to start investigating them. And the media, of course, all along the way helped push all of that negativity too, only for them to now all of a sudden actually start buying Chinese stocks. I mean, I thought you guys said that these were horrible. I thought you said that you'd never recommend these stocks. I thought that nobody should ever touch them. But now all of a sudden you're starting to buy them? Well, let's go back to the articles. According to hedgeweek.com from about a week ago, hedge funds buy Chinese stocks at fastest rate in 5 years. This is one here based on information from Goldman Sachs and also being reported by Reuters. The Chinese market popped 6% after a turnaround in sentiment. Which comes after a long period of hedge funds betting against the market, so probably shorting it, for 8 of the past 10 weeks. Then a week after that, Wall Street Journal reports Chinese stocks have best day in years after Beijing action aimed at helping their markets. And then another report here, this time from The Observer, says that Ray Dalio's Bridgewater, again, this is the biggest hedge fund in the world, it told its investors that the firm is now moderately bullish on Chinese stocks and bonds and that they are now worth holding long term. According to the report, Bridgewater also doubled its assets in China last month. By the way, that was before some of this stuff that we're going to cover here in a second in terms of what China is doing. But how crazy is that? I mean, if you don't believe that, I've got more proof of it. Here's another article. Bloomberg, Bridgewater doubled China assets. Markets Insider, Ray Dalio's Bridgewater has doubled its fund assets in China over the past year. By the way, Ray no longer serves as CEO, but he is still on the board and is a senior investor on their investment committee. But either way, the result of all this, going back to the previous report, Chinese equity funds saw the second largest inflow in history at a whopping $12 billion. So, why the sudden change of heart for all these rich investors? Well, it looks like it has mostly to do with that action being taken by Beijing. See, Chinese stocks were beaten down so heavily that the government had to come out and publicly announce that they will now be supporting these Chinese stocks, the Chinese stock market, and the economy, really, by introducing new stimulus. Now, of course, we've seen announcements like this before, but this one in particular is pretty interesting because not only is China trying to stimulate growth, but they're pretty much going to manufacture it by literally pumping money into the stock market. In fact, they announced a rescue plan that is worth a whopping 278 billion US dollars. That's equivalent to about 2 trillion Chinese yuan, which they're going to fund by using money from state-owned enterprises. Remember, SOEs now make up the majority of all Chinese companies. And so they're basically going to have these companies start investing into more domestic stocks in China. It's pretty wild. Now, how much of an impact will that ultimately have? That's a bit unclear because according to CNBC, various regulations will force them to spread out that buying over months, which will only make up a fraction of trading volume, at least according to them. But the other interesting thing about this is that China is also trying to boost the macroeconomy and they're ailing real estate markets as well. Not only by cutting interest rates a while back, but now they're also cutting the amount that is required by banks to hold in their reserves, what we call the reserve ratio requirement, which China says will free up as much as 1 trillion yuan in long-term capital that will help boost the economy further. So basically freeing up cash for banks to lend out to businesses and developers and stuff like that. Which, to add on top of that, the government will also implement new measures that will further encourage banks to lend to qualified developers, although UBS thinks even more policies will be needed to help stabilize that devastated real estate market from falling property sales, which, by the way, China's property sector is really one of the biggest contributors to their GDP. So for it to be in crisis like it has been, it's something that has really held their entire economy back from experiencing a larger recovery coming off of the pandemic, where stocks have also been crashing all along the way. Speaking of stocks, though, China also noted that they'll now be taking, quote, forceful steps to address investor confidence, which includes the curbing of short selling Chinese stocks. And so while it's not 100% banned, they're now putting new rules and regulations that will make it a lot harder to actually short Chinese stocks, with some forms of it even being flat out illegal. However, many don't agree with the moves and are pessimistic about how much it can actually help. For example, Joseph Foudy, an economics professor at New York University, stated, if the only reason you're getting inflows is because prices are very depressed and the government announces some investments, bans on short selling, and reduced online criticism of the stock market, that doesn't strike me as an optimistic story. Adding that he doesn't view China's stimulus package as an effective tool to jumpstart the economy, saying, quote, if the market is only going up because you have to put a lot of controls on the market, then all those things are going to be viewed as negatives, not positives. Which I do mostly agree with myself. I think there's a lot of underlying issues here that still need to be addressed. However, I'm also not overly negative towards these moves because the way I see it, the biggest thing that has really been holding back China and the Chinese economy and Chinese stocks along with it from really growing and flourishing has always been that authoritarian government that aims to control everything. But if you can get that government to actually now be more on your side, putting more policies in place to help businesses rather than destroy them, or at the very least just kind of get out of the way, well, then I think that many of these beaten down Chinese companies could actually end up rising again. And I think that's why you're now seeing all of these hedge funds all of a sudden start to buy again. Of course, my biggest concern, though, is still the fact that these companies have VIE structures, which leaves very little to no rights for US investors like myself. And the fact that US and China continue to have geopolitical conflict, as well as all the regulatory conflict where America argues that there isn't enough oversight allowed into these Chinese entities, that's all just, the cherry on top of everything here in terms of added risk. But China has at least been working towards a resolution on that front too, promising to give more audit and financial access to US regulators. Plus, I also just feel that China is really always going to want more power and influence over the world. But in order to do that, you're going to need to be involved in the global economy, and you need your companies to thrive and to have foreign investment and influence. So I just don't think it really benefits them to have their biggest companies delist or go under, which would really screw over so many people. I do think it'll probably happen at smaller scales with smaller companies that are lesser known, which is why I don't invest in any of those little Chinese companies that I think have gigantic risk. But I do have just a very small amount invested in some of their biggest players like Alibaba, Tencent, and Baidu. Those are really my personal favorites. But even there, I still see them as like knockoff versions of bigger and safer US companies like Amazon, Microsoft, and Google, which, by the way, is where most of my money is invested, in these very large and safe and profitable American companies. Those are my biggest investments, whereas these Chinese stocks are some of my absolute smallest. In fact, I don't even let my portfolio have more than 10% invested in foreign stocks to begin with, let alone for Chinese stocks, which is even much lower than that. But if you're willing to accept the risk, some of these Chinese companies do have a lot of growth and dominance while also carrying some of the cheapest valuations that you'll find out there. Like, for example, did you know that Alibaba actually has more e-commerce market share than Amazon at almost double the gross merchandise value? Or did you know that Tencent is considered the largest gaming company in the entire world, even ahead of other giants like Sony, Apple, Microsoft, and Google, or that Baidu is basically as close of a direct clone to Google as you can get? But when you look at their valuations, they're almost all on another planet in terms of how cheap they are. Alibaba, for example, trades at a PEG ratio that is almost 70% cheaper than Amazon. Tencent has about half the valuation of other giants like Apple, Microsoft, and Sony. And while Baidu has a similar PEG to Google, it is still less than half the forward PE ratio as well. So again, I'm not saying that these stocks are better or that they're even worth investing in for most people. All I'm trying to show here is why these hedge funds are all of a sudden interested in buying Chinese stocks after having helped crash them into the ground, and are now picking up the smaller pieces given that the Chinese government is implementing new policies to build them back up. Whether or not it actually works though, we'll have to wait and see. Like I said, I still think that most, if not all, investor money should be in safer American companies. But I also feel that a small speculative position in a couple of the biggest Chinese stocks, and especially the ones that I happen to mention, I think is pretty reasonable too. But hey, that's just my opinion. I'd love to hear what you all have to say down below in the comment section. Let me know what you think about anything we discussed. If you agree or disagree with anything I said or that was covered in today's video. I love hearing from you guys and interacting with you down in the comments. But thanks again for stopping by, my friends. I hope you enjoyed the video, and I will catch you in the next one. All right, take care, everybody. Bye-bye.